Welcome to Value After Hours, Markets in Turmoil, Coronavirus Edition Mark II. I'm here with my co-hosts Bill Brewster and Jake Taylor. Jake, what's your topic this week?
Well, I'm going to be discussing how this virus may be the crowbar on the tracks of our train of fragility.
Scary. And Bill, what are you talking about?
I'm going to talk about how this all made me a little more introspective as an investor and my perceived benefits of holding more anti-fragile businesses.
And I'll be talking about what the high yield index can tell us about the stock market in decline, coming up right after this.
Tobias Carlisle is the founder and principal of Acquires Funds. For regulatory reasons, he will not discuss any of the Acquires Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquires Funds or affiliates. For more information, visit acquiresfunds.com.
We're recording March 11. SPY currently at 265. We're down about 4.65% for the day. So the market is truly trading like a penny stock. It's up and down 5% every single day. I think that there's some genuine damage occurring to the underlying fundamentals as well, and we're going to talk about that in a little bit. But let's start with the topic that is front of mind, and that's coronavirus. Jake, that's your topic.
Wait, real quick. Trigger warning to Google. Please don't demonetize us. We are
this
having
one's
a
gone.
legit discussion.
$6
We're having a
is
legit
gone.
discussion.
No warheads. No warheads.
Oh, well, we'll have to have the conversation anyway. That's, you know why? Because we care about the people. We're not in it for the money.
That's exactly right. There's $6. We're foregoing that.
I don't want people to know how much we're making on this, so
That's
we
gross.
might have to scrub the $6. We're starting to really monetize those 10 listeners.
Yeah, the ARPU is going through the roof.
Strong. I got to say, what do you guys think? You think we trade at 45 times sales? Or revenues, rather?
This is a podcast. Podcast's very valuable right now.
That's right.
Easy.
High ROIC, quick growth. I don't know. I think it's worth at least $20,000. What do you guys think?
Well, now that we have your microphone actually plugged in, like the sky is the limit.
Right, there we go.
Yeah.
Some
now
of the
you all
parts.
hear my sweet, sweet voice.
So my segment is going to be how the coronavirus might be the crowbar on the tracks that is derailing a lot of the fragility that we've built up in our system. So I'm gonna do it in sections, and maybe I'll try to keep each section, and then you guys riff on it.
Sounds like a plan. Oh, the fucking Matrix.
Someone start. Yeah, let's. I didn't say anything yet.
I tried to hold you back, though. We won't let it.
All right, so first place to start is let's go with the supply chain. So just in time, they like to talk about how it can increase decrease your inventory expenses by up to 75%. And they highlight companies like Toyota and Dell and Harley and how it's such a good thing that we have this just in time. Well, that's maybe turning out to be a fragile situation and a short win and a long loss. Potentially. You look at the iPhone and it's built in 10 different countries. Everything is shipping all over the world to get to us. 80% of our antibiotics are made in China. So, we have all these different things that are very important to our day-to-day lives that are based on a just-in-time framework. So topic number one, I guess, is how fragile is our supply chain?
Yeah, fragile. I've been saying this for a little while on different podcasts, but I think that some of that, China's the just-in-time manufacturing hub for the entire world, and you've got lots of things out there that even if they have just one component in them, and they're sitting waiting for that one component, the thing doesn't get made. So I think that this problem is something that rolls on and on and on. I probably have to revisit just in time. I don't know if that's a sensible way of doing it. Maybe you got to stockpile more parts.
Yeah, I mean, I said it last week. I'll say it again. Dan McMurtry was like way ahead of the curve on this. I mean, he highlighted this exact issue 3 weeks ago. My man Charlie Grant, he just said on Twitter that he got some major Dow component company said like there's no way we're going to V back from this because the supply chain's so messed up.
Going to be back at all?
No. Like, so I think what his comment is if you are betting on a V-shaped recovery from this, it's just structurally impossible for some of these companies to V back. Like I happen to be pretty bullish on service industry and travel related companies because you don't need the supply chain to come back together. You just need people to be confident to travel again. And it's also the sector that's gotten the shit kicked out of it lately. So that's where most of my focus is. But like, if you think, I don't know, whatever manufacturing company you want to pick, it's going to take a while to get all this stuff put back together again. I was talking to my neighbor is in private equity. He does retail focused private equity. He has some company that distributes through either Walmart or Five Below or something like that. They're planning on 2 months of no inventory. Like they're just not going to have product for 2 months. That's their base case. That's crazy.
Scary. Yeah. So speaking of travel, a few things for you we live in an interconnected world like never before. And if you look at Jeffrey West has this interesting book called Scale, which is all about like networks and, big cities tend to produce more of everything that is human. So including innovation, economics, but also disease, sickness, like it spreads faster. And so the number of global arrivals, according to the World Bank, in 2009 was 900 million. So that's how many people went to another country and touched down there. By 2018, it was 1.5 billion. So we have a disease or a virus like coronavirus has the potential of getting all over the world and really showing us that an interconnected world has its downsides as well.
Here's a question that I've been thinking about in relation to that. Why is it that some countries in the world are so far behind so that everybody knows that by now that it doubles every
5
day
to 8
or so.
days is
doubles
what,
every 5 to 8 days.
That's what I've been reading so far in a couple different places.
And so you can look at what's happened in these other countries and say that's what the future looks like for the US. But why is the US already so? What has happened to make the US to make us so far behind that process? And it's the UK, the US, Australia as well is sort of delayed. Whereas there are some countries like Italy, China, naturally. Iran was caught really early. Why is that? Why is there such a lag between some countries and others?
I don't know. I think it's we just haven't gotten there yet. I think we're just like on the same train.
I agree.
We're a few cars back.
I'm just wondering why we're that far back.
Well, I mean, do we know that we're actually that far back? Right? I mean, part of the issue is the amount of testing.
That's a good point.
So, I mean, like I was talking to my buddy's girlfriend who is an ER nurse, and she's like losing sleep right now because she's like, we are already at capacity and this flu season is already bad. And she managed through the swine flu. That was her first year nursing. They had to have pop-up hospitals. Like they had to build tents out back. And she was like, people aren't really thinking like, God forbid you break your arm or you need an emergency service. How are the nurses? Like your nurses might be sick. How are they going to be? I mean, there's just a lot of issues right now that are coming. And I think maybe people are attributing flu symptoms to this. I don't know. Google again. I'm sorry. I'm not trying to spread misinformation. I'm just having a discussion here.
So as of yesterday, we were at 1,000 confirmed cases in the U.S.
That seems low.
Well,
yeah, it is low.
Well, when you don't test, you don't have to worry about it. But
that was my high school theory.
Doubling every 5 to 8 days. Yeah, good point.
Yeah.
I mean, there are anywhere from 50 to 65,000 ICU beds in the U.S. And they're different numbers for some reason. I don't know why, but we're in 30 days from now. doubling every 5 to 8 days, we're at 64,000 at that point, right? So within a month, we'll have all of the ICU beds full. If they aren't, we're already full with people with other things, right? So like we're medically, I think we're very flat-footed for this. And not just medically, but actually from a health standpoint. One of the big predictors of morbidity for this is like other cofactors like smoking and obesity. And that actually should be quite a bit of concern for us, because in 2018, the CDC had us at 42% obesity rate in the US. We have a similar number who are deficient in vitamin D, which may be another thing that would help us fight off a virus like this.
Does getting sun help you there?
Yeah, are you telling me that this is my pitch to move out of Chicago? Vitamin D deficiency.
Just go stare at the sun.
I think this is the pitch.
I can't, dude. Have you seen Chicago weather in the winter? Actually, this has been a nice winter. This has been nice, but
I think the pitch is honestly for you. If you to manufacture that heart attack moment that makes you kind of get your shit together from a health standpoint, this is a great time to reevaluate your health protocols for your own health. And like, if you ever needed a reason to want to take it up a notch in how you take care of yourself, like this is a great reason to do it. 35% of us aren't getting enough sleep. 9 million adults are diagnosed with chronic bronchitis. I mean, we're unhealthy already. I wouldn't be shocked if we didn't have even maybe somewhat higher mortality rates than what some people are predicting, that 1 to 2 to 3%. If it gets into the population that is already at risk due to poor health previously, like holy shit, this could be pretty bad.
Yeah, I that's sort of, I guess, in retrospect over the past 3 weeks, how my thinking on this has really shifted is I didn't understand how the wave worked, right? Like my mind wasn't mathematically doubling every couple days. And I didn't also understand sort of how constricted the system was in conjunction with the wave, right? So I think I thought this would be a lot shorter in duration than I do now. And what did you say? You said a couple things that I triggered investment related thoughts. Oh, I was listening to a call that JP Morgan had, and the guy said, he's like, part of the problem, right, is so I used to own AB InBev. I'm out. I've been out for a little bit, and the reason is I was listening to this call, and he just said, like, it's about to get cold in the southern hemisphere, and they are fundamentally not prepared from a health standpoint. And if you are a company and your growth is dependent on emerging markets, and God forbid you have leverage on top of that, I want nothing to do with it. I sold Philip Morris for the same reason. I thought that I had assumed a decline curve, and this is like totally illuminated a risk that I just don't, want to have to deal with, because this thing is mowing down smokers. I don't know. I really... at the risk of sounding alarmist, I really hope it is sort of not what everybody's worried about. I grew up in Florida. We always used to worry about hurricanes, and they didn't come, and I was happy about that. But yeah, this thing could get bad.
I think often the reason that things are better than people expect is that people do something about it in the as they see it coming. And like the US has been quite fortunate in that we are the last train in the caboose and not at the front of the train, and so we have had more time, but we have done nothing with it, so that makes me a little bit nervous.
Dude, it's so frustrating, and that's what I sent out a tweet today. We'll see if Trump sees it. I'm sure I'm the only one he's seeing, but that's what I said. I was like, if you want the stock market to sort of
get some
settle,
confidence,
like fucking come out and say the army is here to help, and we are ready to set up temporary hospitals, and we'll get through this together. And yeah, it might be bad. Floating a payroll tax cut, like that is insane to me.
Yeah, cut rates. That's the only thing.
You're gonna bail
that's
out
the only thing that works.
Like shale. Okay, cool. We're gonna bail out the uneconomic industry in the U.S.
What about bailing out the cruise companies, where they're all owned by billionaires and they don't list and pay? They're not domiciled in the states for taxes.
It's so
you go down if that happens.
So I think we're also, from a financial standpoint, flat-footed. Like, we've come into this with rates that are already crazy low, trillion-dollar deficits, tax structures already lowered from previous, all-time debt levels out of control at different levels. All these, I think there's going to be a lot of questionable debt and then buyback management questions. Like, dude, what were you guys doing here, right? Like, you were not preparing for a rainy day at all. And then markets are crazy expensive. Like, all of these things are, from a financial standpoint. And then one other thing.
Rates are low, bro. Markets aren't expensive because rates are low.
Are they low or do they not exist?
Yeah, right.
To the listeners, I've put my whole portfolio in 10-year treasuries. I've totally switched. I've determined that they're going to 10 basis points.
We've got no idea where they are at the moment because we're recording this 10 days before this comes out. Maybe we'll try and release it a little bit earlier, but it seems
probably
like
be negative.
The moves are very violent in between podcasts.
Yeah. So let me ask you this: what jobs were added since 2009 for the most part?
Instagram influencer.
Okay.
It's been sweet. Podcaster.
Yeah. How about more like service, right? Like bartenders, baristas. If people stop going out for things for a significant period of time, that's like all of those jobs that were supposedly added are, I think, the most at risk.
Yes.
And those are people also who are closest to the edge, right? Like they're...
Yes, that's why the payroll tax... Who does the payroll tax... I mean, it helps a lot of us, but a lot of the people are white-collar workers that can work from home anyway. It's not going to do shit for the service industry. My buddy's restaurant did 170 dinners 2 weeks ago. It did 70 last week. This is just the beginning.
Operational leverage goes the other way, too.
Yeah. People don't even know how serious... I mean, people are starting to understand how serious this is, but yeah, I mean, that's why I was saying 2 weeks ago, before I sort of understood how the virus passed, I was like, we're really going to shut down the economy. I mean, it's not just the direct first-order effects. It's all the tangential industries. Like, what does Vegas look like over the next 12 months? It's not going to be good.
No. Okay, so one last thing. 60% of households with kids have two working parents. What do we do when they shut down the schools to keep from trying to infect everybody, and all these kids are at home now with two parents who are supposed to be working? Like that, and what do you like bring in the grandparents who are to watch them, who are the most at risk? Like that's a really nasty cocktail.
Yeah, you just don't work.
You just don't.
What do you do if you're a healthcare provider, and your kids are at home?
I don't know, but we need you on the front lines.
Yeah, I mean, this is why the market's off so hard. I think, this is
all the way back to 2019 levels.
I hate to be a fearmonger when the market's off, but I kind of feel like the market is still expensive where it is. Who knows what happens? But
Ackman thinks so too. Right, I mean that was what he just wrote with the Pershing Square letter. He said, our hedges are working, and I'm pretty sure he said, I don't think this is a bottom. I don't
my
think
shorts have certainly been working. I'm very happy with the shorts at the moment. The longs have been letting the team down a little bit. Value longs, if anybody's been watching values, again, the worst performing factor through the crisis. But we all hope that it comes back one day. In maybe the 2100s or the 2200s.
Well, you have long duration.
Yeah, not me personally. I mean, my descendants.
Yeah.
I think a lot of value guys, I know certainly myself, I mean, I'm long financials. I'm not particularly worried. I mean, we're going to be buying in shares here, so we'll see in 5 years how it all looks.
Yeah, in all seriousness, I kind of like the value portfolio.
With what
here.
revenue?
I think it's the value names are very, very cheap. And I think I've been talking about this a little bit on Twitter, but I think Berkshire's getting to one of those half-generational opportunities where it is right now. It's as cheap now as it was in the 2009 low and the 2011 low. There are 68 days between now and the very peak in 2007 out of like 3,000 something days where it's been cheaper. So I think it's stonkingly good value here.
It is a lot of my portfolio, and I have slept very well at night.
If there's two guys I trust to manage through it, it's those two guys, provided they avoid the flu, and that is a genuine fortress balance sheet.
I mean, I don't want to lose those guys, but let's say they don't avoid the flu. I think they got a pretty good team behind them. Now, what happens in 5 years, and do the managers continue to work? That's sort of something you got to watch. But, I mean, I have gotten on Buffett for the buybacks. I have gotten on him for accumulating all the cash. I have deferred to him because I thought he's smart. Guess what? He is. Like right now, it is super easy to sleep right now when you have Berkshire in your portfolio. Same with Charter. Like Charter, I mean, I hope this stock gets cut in half. They are going to eat so much of themselves because you're going to pay your broadband bill. So
might
let's
be the
go.
only thing I pay, the internet bill.
That's right. So let's do it. Chop it in half. I want to own more of that. I'm cool.
So let's maybe that's a good point to segue to your topic, Bill. You've given some thoughts to managing value through a crisis. We're down. We're not. I don't know if we're down 20% yet, but we're down
Close. I think.
We're kissing it. We're very close. And the way that the market moves, it could go through it tomorrow. It could go through it before the end of the day.
Yeah. I just, so, I mean, I've been super public about thinking the airlines are different. That has been a situation where if in my underwriting you had said, okay, well, what happens if you just chop revenue in half for a year or make it go to zero, park every single plane in the U.S., and what's your business look like now? I would have dismissed that as like, what are you even talking about, right? And I guess what this has really forced me to think about is that's actually a possibility. And it's certainly more probable than I thought it may be. And maybe we are looking at a black swan, right? I mean, maybe this is sort of the left tail manifesting itself. Maybe it's just sort of natural order of things. But I think that, really thinking about how resilient the businesses that I own are, and do I want to really own them through the downside, and not being as dismissive of what risk looks like.
How are you assessing the resiliency?
I mean, I think that, well, with the airlines, it's sort of different. I mean, I'm concerned and remain concerned about liquidity. And I have always been like, well, I'll just buy the best breed in balance sheet. But, I mean, it's a lot of operating leverage in the short term, and they burn a fair amount of cash. Now, they get some help on oil, and you have your yields are like 65%, I think I heard, but they're losing all the business booking, and that's a lot of the front end booking. There's a lot of margin in that. And I'm not sure that business, like in the social media age, I don't think you want to be the first business or set of businesses that say, go travel again. So I don't know how long this can last. I think people are, or I know I certainly underestimated how long this could last, because I thought it would be like a shock event and then you move on. I think they're doing all the right things. I just don't know, how much is in their control. I think you find out after it. So, to that extent, that business fundamentally will always warrant a lower multiple than something like Charter, where you do have subscription broadband revenues that even if we all have to shelter in place, they're getting paid. So that's just sort of the stuff that I've been thinking about. And like I said, I mean, I sold AB InBev. I was obviously wrong if I sold. I wish that there were alternative paths of the world that I didn't have to play this hand, but this is the hand. So, maybe in the future I focus a little bit more on anti-fragile businesses.
Where's the anti-fragility come from for you? Is it just the balance sheet?
Well, I just said it can't be, right? So it's got to be some combination. It can't be that alone, but it's got to be some combination of the balance sheet and a cost structure that sort of allows you to flex up and down, would be what I would say.
How about management?
Yeah, a ton, in culture. Like, I know, I mean, I'm not at all worried about Markel and Sarab and Tom and Dan doing the right things right now. Like, it doesn't even cross my mind. If the stock got chopped in half, I'd be like, all right, cool, let's go. Like, these are my soldiers, I'm down to ride. Some of these other businesses, though, like, I don't feel that way about. And that's why I sort of have avoided some of the less. I mean, I hate to pick on it, but like EAF, now you get to see what credit risk on those contracts actually looks like. Like, was the steel industry ready to do this? Like, if this is a prolonged problem? I don't think so. That's why I never really liked that idea.
This is slightly tangential, but along the same line. Energy, a few days ago, got absolutely taken to the woodshed. Oils off so much.
1927 style. Occidental off 53%.
Well, Oxy was where I was going. So Oxy, that's a for folks who don't know. So the way that they did the deal was they issued this $10 billion pref to Buffett that pays him $200 million a quarter. So they didn't have to therefore go and get shareholder approval to get the deal through. And so now they've cut their dividend to the point where they're paying, I think Buffett gets half of the cash flows that get paid out in dividends. And he's got the $10 billion pref. I said in Twitter yesterday, like, congrats to Buffett. Like, nothing against him. Like, you do the deal you can get, but that is sort of criminally dumb by the management of Oxy to have, you don't go and get shareholder approval for something like that. That's outrageous.
It's gross corporate negligence.
Yeah, this is what Energy FinTwit is just shat all over her for the entire time. And like, ridiculous. Guess what? It happened. That said, I'm about to talk out of both sides of my mouth. Right now, like something like Chevron is sort of intriguing to me because it's very hard to argue to me that you can get a more bombed out story than oil right now.
Energy and airlines, like you got a kind of little hedge built into it already. I kind of like those trades. Get the fortress balance sheets, get the good businesses. Like that's how this stuff works. You got to get in there and buy that sort of stuff.
Here's the only pushback that I've given myself on airlines, because since it's been almost 100% of my time and mind share, is what's the scenario? So you could wait to buy these things and you could see how they actually perform. And what are you really going to give up on the upside versus what risk you're taking by trying to be early on it? I think that there's a legitimate argument to be made to me that the risk reward skew is potentially better waiting to the end of this and seeing, like, I mean, right now people are game theorying what does a government bailout look like? Like that. I mean, that's not super fun to invest into. And I get that you're getting a discount, but like Delta's still a $27 billion entity. It's not like you're not buying an option here. So I don't know that the risk reward skew is quite what it should be. And I don't think they're going to double overnight so you can watch it. That would be the only pushback I have.
Yeah, that's a fair point. So I have two thoughts there. One is you kind of got to strike while the iron's hot, and when you get the opportunities, you got to buy them.
That's right.
But you don't necessarily have to fill up the entire position. You can buy some, see what happens, and buy some more. Because you're right, like there is still a lot of risk in all of those positions. Oil, nobody really knows where that's going. Airlines, nobody really knows where that's going.
And I do think there's a lot of bets right now that are pretty correlated, that if you look at a drawdown perspective, like, I mean, Formula One, Booking.com, Live Nation, Vail Resorts, like, I mean, those are some Class A assets that I think have a lot of the same risk right now that you could probably hide in and make a very similar trade.
The only safe place is Tesla.
I know that's sounding like a trader. Yeah. And I'm not trying to sound like a trader, but I do think that that's something people at least should think about. Something I've been thinking about.
What are you doing, Jake? Are you buying anything?
Yeah, like Tesla.
Anything? Oh, that's for your investors to know and everybody else to find out.
Are you selling puts on Tesla? Try to harvest that premium before you buy in cheap?
No, it's radioactive. It doesn't matter.
You can't be long or short that thing, and I am short it, unfortunately, in full disclosure.
Too dangerous. Yeah, I mean, I've been nibbling some of the things that I already owned that have gotten more attractive, but in general, I've been kind of waiting and seeing. Like you said, I think it's still pretty expensive relative to the bigger impacts that I think are possible. I think we're still maybe discounting that this is just going to like blow over and like V back, and that and granted, like we've had 10 or 11 years now of every single little hiccup, whether it was a government shutdown or European crisis, Greeks. Everything has been a quick rebound, and then onward we march upward. I'm not sure it's going to be the same this time. I think, and granted, I probably would have thought some of these other things would have had bigger problems too, but we've just shrugged them off. I don't want to lose sight of being generally an optimist, because I think that's the right way to approach the world and investing. I think that you get paid to be an optimist generally, but in this case, I feel like we're still sort of underappreciating the price tells me that we're underappreciating the risks still.
I think that the real difference, like for me, the 2018 dip was pretty easy to buy. This one, I have been much, much more cautious. And I think the reason is, despite what you guys just told me that Mnuchin said, is like this absolutely has an economic impact. And I think that anyone that doesn't think that I don't know what Gunlock's 40% must be at 80 now. I mean, the amount of economic activity that's going to be pulled in for a while, I don't think it's that easy to just buy this dip. And famous last words, I'm not like going to cash or anything like that, but I don't think this one is just some sell-off.
Yeah, it's
I'm with dragging my feet.
I'm with you, Jake, that like because I've been through 2 gigantic drawdowns, I sort of in every single one of them, I always thought, the rookie error is to shoot all of your ammo in the first few days and weeks. And then basically what that's meant is that in the last 11 years, every time it's happened, I've kind of been just warming up and stretching, and we're already back to all-time highs.
Yeah, same here.
So it's a slightly different situation now, but I still have some cash. I still have, I've got a whole lot of cheap stuff, and I like the way you frame it up. It's all got a lot more attractive since this whole thing started happening, which means it's down a lot.
Yes.
The only kind of bright spot is that I feel like the portfolio has been doing much better than comparable value portfolios, because I've got some shorts in there, and I've tended to buy sectors that tend to be a little bit cheaper, so I think that they have been a little bit better protected. I don't think you get to see the full strength of or the full strength of value until this thing really gets rolling. I really don't think value is going to be punished all the way down. I think what happens is value sells.
We've already gotten it.
We sold off for 2 months before this started. So this is one of the funny things. Like coronavirus is the trigger.
Yeah, you did say that before. Yeah, you did say that before.
Coronavirus is the trigger, but I kind of feel like something was I felt like something was coming a long time before that, because we were already selling off, and you see it in value when the value starts selling off. So value has already value's in its bear market now, well and truly in its bear market, probably has been for 4 weeks done. Like you look at a composite of value funds. Corey Hofstein has them on his site. I can pull it up and put it in the notes to this, but you'll see that it's 20% down, so definitionally bear market. Sorry. I think that it's been coming. Like coronavirus happens to be the trigger, but it just about could have been anything that gave people a little bit of fright. But I actually now do think that coronavirus is going to be, you don't see the reporting for Q2 when it really starts to bite until Q3. It's something that is with us in reporting, in earnings for a really long, like at least probably till the end of the year.
I'm pretty interested to see how like true retail money starts to respond to the headlines. I mean, I've talked to some people that, like, my one buddy was just telling me how he thinks the market knows, and I'm like, I buy that a lot, and I can understand, like, yeah, the market sees forward 18 months. People, the average person that I've talked to that's outside of finance does not understand at all what the headlines are yet. And you start to see your like, if I was a boomer, okay, and I owned ETFs and I actually started to lose friends, and my ETF was down, and I had 2009 PTSD, I don't know that I'd stick around. I think people are going to be put a pretty strong decision here, and I'll be interested to see sort of how that all goes, because you could have some panic selling when the headlines get scary.
I do think the market is often ahead of the headlines, and I don't know how that happens, but it's just the market seems to bottom close to when the.
Mm-hmm.
I have no idea how it happens. It's just one of those wisdom of crowds type ideas. It does seem to work, but I don't know. So that's why that makes it sound like I'm making a pretty strong argument for technical analysis there, which I guess if I could read the charts, I would, but I don't think anybody can read the charts. I think it's all obvious in hindsight and not prospectively.
Yeah, I mean, I think you have to be comfortable with the idea that you're going to be early. But I mean, what's a typical drawdown has been 18 months on average.
Yeah.
If you just had to throw a dart, something like that. All right. How far are we into this one? Like a month and a half or something? I don't know. 2 years? It feels like it's been 2 years. Is it? Or is it like 5 days?
The crazy thing is that this has been so fast. So I don't know what that does. I don't know what that means. I don't know if that means recover faster too. I mean, I don't think it's a V bottom, but I don't think it's an 18-month one either.
Ice pick instead.
Yeah. Gee. That's probably a good analogy. But it's funny. Maybe we are living in this accelerated age where when things sell off, they recover faster too. But I don't think it's like a V-shaped bottom. I think it's going to look more like 2000 or 2007, 2009.
I don't know. It's going to be interesting, man. A lot of these SaaS companies that rely on sales forces that get on airplanes to do deployments and stuff, you better take your growth assumptions in at least for a year. And maybe it doesn't matter, right? But we'll see. I don't know. People are going to be – you're going to find out how much conviction there is in some of these names. I'm hoping not much.
Conviction in your Vanguard ETF? I mean, does anybody really have conviction in that? Or is it more just like –
Yeah, well, that's panic selling, right?
As Michael Green points out, though, a lot of that is investment that just comes out of paychecks that people never consider at all. Like they have no emotion about it whatsoever. It just gets funneled into those, to many of those ETFs. So that bid is still going to be there
when things are going up.
Well, that's true. Do you change that? It's going into your retirement account.
I remember the people that I worked with in 2009, and it was like, no, that's going to cash now.
All right.
That's going into the money market account, not the market just keeps going down. Why would I put it in that?
Couldn't hide in money market accounts either.
I mean, that's true.
You got no trading fees now. I don't know. I just think it's interesting.
Well, you can't trade on Robinhood.
Yeah, that's true.
No fees, but no trading either.
Who do you think? Where's the first like Bear Stearns hedge fund that blows up?
I can't believe we haven't seen it yet. Energy.
I know. Something had to have blown up by now, right? Where's the high-profile explosion of something?
I'm astonished we haven't seen it.
It's not Ackman. He hedged.
Yeah,
he crushed it on that hedge. I just think that there are times that I have held cash, and I've done it in order to be sort of like anti-fragile, and on the way up, it hurts. Like it really sucks to underperform. And it feels so good to watch something like this and be like, you know what? This is why I planned. And I just think that that's why, people need to think about the bad times when it's good times. And then in the bad times, there's some names here that probably are going to be a lot higher in 18 months, 24 months. So, it's a matter of being able to live through a little bit of a drawdown.
3 to 5 years.
Yeah, we'll see.
I'm going to paraphrase Bill. Here's what Bill's saying. Suck it, all you grasshoppers.
No, that's not what I'm saying. I have gotten blown up in some names. I fucking bought Schwab. Schwab has been just decimated. I'm not sitting here like a Twitter flex saying I'm up 70%. That's bullshit. It's been painful. But I am happy with the top of my portfolio, and I'm not selling any of it.
All right, let's do my topic.
Yes, please.
So, Dan Rasmussen had a nice tweet where he said, if you watch the high yield spreads, they are often early to big drawdowns, and then you can take away some guidelines for when the market recovers and so on. So if you watch them, so the high yield spread, you can actually dig this data series up for yourself. It's available free online. You get it from the St. Louis Fed. St. Louis. How do you say that?
St. Louis.
I think it's St. Louis. I mean, at least in America.
Yeah, that's my accent. No, sorry, St. Louis. I'll get that right next time. I will put this in the show notes as well, but it's so you can look it up yourself. ICE B of A, Bank of America, US High Yield Index Option Adjusted Spread. So the numbers in the data series goes back to 1996. And you can see very clearly it blows through. So the numbers to watch are sort of somewhere between 6 and 8%. When it goes,
can you explain what it is? Like it's high yield debt minus.
Yes, sorry. Yeah, it's high yield. It's the high yielding debt minus the 10-year, and it just looks at so this is the junk spread. This is what leverage borrowers typically have to pay. So when these rates blow out, this is often when you see it's not just a equity correction, there's some underlying problem as well. I think that's what it sort of demonstrates, because they start demanding higher yields to underwrite a lot of this stuff. So we saw,
and just real quick, the OAS is option adjusted spread. So when I was in CFA level 2 preparation, I could tell you what that means. What I'll tell you now is Google it. It's the proper one to look at.
I did say option adjusted spread then, didn't I?
Yeah. I'm just saying that because we had asked
when
to
it comes
explain
up
what it was. So I was just saying it's.
You had to just drop that CFA.
Drop
come
some
on.
Was that what level CFA do they teach you that?
I don't know.
I think it's 2. I think 2 is the one that you got to.
There we go.
I'm lashing out because I'm afraid of coronavirus. I'm sorry, though.
Okay. Get your mask on.
The only point that I would make about this chart is that it blew up in 1998, blew up in 2007, it blew up in 2011, it blew up in 2016. 2011, 2016 were pretty mild. It just got to 8 in 2011. It didn't quite get to 8 in 2016, but it went through like 6 pretty. In both instances, the 2001 and the 2007 one were like very substantial. You can look at it on the chart. You'll see how peaky it got. So it doesn't necessarily have to get to that kind of level, but we have gone through 6. We went through 6.8 yesterday. We've come back a little bit today to 6.38. It's updated every single day. So it's very, very steep at the moment. So I don't know whether that means it's going to come back down very steeply or whether we're at the beginning of something that's a very violent move. But it's worth just watching that because it sort of gives you an idea. And when it starts recovering, I think that's a pretty good indication that a lot of the underlying credit pain is leaking away. And I would say that'll be close to the bottom for the stock market. It moves all over the place, but it's just worth watching because it tells you something more than, you're not trying to just pick a bottom in the equity market. You're looking at the fundamentals of the market too.
We'll probably come back in when we bail out shale.
Yeah.
I mean, how much of that index is shale? I bet it's a ton.
I have no idea, but
I bet
there's a lot of energy in there, I'm sure.
Yeah, fuck yeah, there is. I mean, it's going to be the idea that we might bail that out is like really funny to me. I mean, it's like very infuriating, but it's also very funny.
Why are the bailouts going to shale and to Carnival cruises?
These are the questions that I have as well, sir. They should be going to the service sector.
I think either of those things can either we can lose them and we'll be fine.
Yeah.
Sorry to all the shale and Carnival cruise guys out there. And also the Carnival, the cruise lines are all domiciled offshore and not paying tax in the States. So that kind of excludes you, right?
Yeah, the waiters should be cut direct checks. I know it's hard to do it, but if you want to help the people that are hurt, not over-levered billionaire oil people that are hiding in an LLC and levering up like crazy. Get out of here. You can take your loss. I'd be more in favor of removing their limited liability company protections and clawing back their actual personal wealth than I would bailing them out.
Well, that should go first before you get the bailout.
Yeah. Get out of here with this. But I guess, it gets systemic if you have too many debt defaults.
But doesn't bankruptcy, isn't that what bankruptcy does? It just wipes out the equity, wipes out the next layer until you get to the folks who were lending securely. And then they take control of the assets and hand it on to the next entrepreneur who's got some plan for them. I think that's a pretty good way of doing it, isn't it? That's the fairest way of doing it.
I think you just described capitalism.
Yeah,
but
that's how it's supposed to work.
Yeah, unfortunately, we sell puts under everything now, so that doesn't exist. It is insane. Terrible policy.
Well, I mean, it's not surprising though. I mean, we we have a track record of that now, right? And like the quickness that they already were talking about it, though, is what surprises me. Like, shit hasn't even gotten real yet, and they're already talking about bailing people out. What?
Yeah.
I mean, I get it. Maybe I don't get it actually from a long run perspective, but all right, GM, AIG, maybe the banks, like some of these things, maybe in 2008 were actually systemic risks.
You still wipe out the equity.
Yeah. Well, I mean, they kind of did with AIG, but to already be talking about that is just, to me, like you were just telling them, like, you know what, just keep doing all the dumb things you were doing because we got your back.
I have a soft spot in my heart for airlines, obviously. I would say that that's actually an industry that I would be okay bailing out, given that if we're saying, like...
But what levels does the bailout come in at? This is my question. Do you bail out the equity holders, or do you bail out the airline and wipe out the equity holders? And I say this as an equity holder.
I know. That's the thing that's tough about it. And I guess, I mean, I've had this conversation with myself. So I've thought, like, on one hand, you have got to at least let the equity holders keep some of it. Otherwise, you may not get to finance them in the future. Right?
There'll
like,
be
you got to
there.
have.
There'll be people there.
Yeah.
That's what happens. That's business.
It's called progress. You know what I just realized is that we're all Sears.
What?
I realized that we're all Sears. We're all heading towards Sears.
I don't know. I'm pretty optimistic. I think this is going to be a painful period, but I think we're all going to get through it just fine.
No,
Famous
I
last
agree.
words.
That's how I feel about all the Sears real estate. It's just who's going to be the owner of it may dramatically change.
Yeah. Well, and like that's the thing about the cruise. Like, why do you need to bail those guys out? Don't they have debt holders there? Like, let those guys fight it out. Figure out where the fulcrum asset or whatever is. Like, just be done with it. Instead, we're going to write them a check. Like, that doesn't make sense. Anyway.
All right. Question.
I got a mailbag too.
You got a mailbag? Good. Do you want to you go with your mailbag question?
You go ahead because I got to find it.
This is from Kevin Marks. This is a tough one, so enjoy this one. Buying a bond is secure because one can always hold it to maturity. If we're talking about government-backed instruments, you can see how that's a hedge. That's insurance. So we're talking about, owning TLT or something like this into it. If you buy a bond ETF, they're not market-driven. Can they not drop like other equities responding to liquidity issues?
Bill, I'll let you handle this easy one.
No.
I don't claim to understand all of the dynamics of some of like how these funds work. I've heard people talk about how a mismatch in liquidity of the underlying compared to the derivative of it, which is the TLT in this instance, that could cause serious problems. I don't quite understand why. Like, I guess you probably just like the price can just move more than you're willing to imagine when you thought you were buying something very secure. I don't know. What else you guys have to add to that?
Yeah, you're always as liquid. An ETF is as liquid as the underlying assets, not the liquidity of the ETF. So you can't buy something you can't have an underlying asset that's very illiquid and put a liquid ETF on it and expect for the liquidity in the ETF to persist through the most illiquid times in the underlying asset. I think that TLT, though, I mean, I said TLT, I introduced TLT. That's not actually in the question, but I sort of assumed that that's what the question was driving at. I think government...
High yield isn't as liquid as the ETF is, right? I mean, the ETF and high yield, you could have some underlying
They
issues.
can be trading in the ETF. You don't have to... That doesn't necessarily make any impact at all on the underlying instrument because people can just buy and sell. But there are times when the liquidity dries up, like when markets crash, that's when the liquidity goes away and the underlying asset liquidity becomes the question. I still think government-backed securities, government-backed bonds, still going to be very, very liquid. I wouldn't be too concerned about those ETFs. But that's a good question to ask, though. You should look at what you're buying. Are you buying an exchange-traded note? Are you buying an exchange-traded fund? Where is your counterparty risk? What happens what is the fund made up of? Is the fund made up of holdings in the underlying asset, or is it some sort of swap written with a bank where you got to watch their their creditworthiness as well. Yeah, your counterpart. You do have to think about those things. Look at who your counterparties are. Make sure you understand the structure. Make sure you understand the underlying liquidity in the assets, because that's the time when you go to lean on these things is probably when all the liquidity dries up. So, great question. Thanks, Kevin.
Well, and the biggest problem with a lot of these bond constructions, right, is like they are market cap weighted to the debt outstanding. So if you're holding a bond ETF, you are actually holding more of the issuers that need to issue more paper, which means fundamentally your credit quality is not as good as you may think it is. Like that, I personally have never understood bond ETFs, and I think.
What about TLT?
Yeah, I think that's probably fine. I mean, I don't.
You mean like the corporate, the high yield stuff?
Yeah, that's right. Yeah.
What percentage of people who own a bond index fund have even a tenth of the knowledge or understanding of how it operates that to actually be an owner of it?
Not 1%. Many, but then are you really
the 1%?
But there's also an argument that that's kind of why you invest in a fund rather than going and doing it yourself. You trust the manager to execute the strategy that they have kind of written down. But that's why you should read. You should at least have a look at the documentation. I know it's all terrible.
No one does it.
It's so hard to read.
And you know what's going to happen is it's all going to blow up, and then people are going to be like, "Oh, the system screwed me. You screwed yourself. You played yourself, fool." You bought stuff you didn't know. You played yourself. Get out of here with that nonsense.
I hope this doesn't come back to haunt us, this conversation.
It may. All right, next one from my man Brock Briggs. Listener 10, he murdered listener 9 to get to right in the 10 slot, which is aggressive, but I appreciate the commitment. Anyway, after my bad jokes. For all of us that manage our own personal money, especially small amounts, how can price play a role in stock selection? I don't want to dictate what I buy based on price, but if a guy only has a few $100 a month to invest, buying one share of Apple may not be as effective as maybe buying 5 to 10 of a stock that's cheaper. I wouldn't think that way personally. I think you value the business and then you buy the fractional interest in the business that you can afford to buy. And that's how I would think about it. I wouldn't think about share price. And actually, aren't there studies that show that higher share prices actually lead to outperformance? It's clearly not causal.
Because they all
but I
include
think,
Berkshire.
Yeah.
No, but I think it has something to do with management teams that are not very concerned with doing stuff like having splits. It's obviously not the cause, but I think it's a correlation.
Isn't it just the fact that they went up to a high share price kind of make them, by definition, like your sampling error seems like it would be high there?
Whatever, bro.
That's a good point.
You could have a 1 for 10 or 1 for 10 split, right? Or would it be the other way? You know what I'm saying?
Yeah, get it up there.
What they were doing.
It's share Viagra.
I never ever look at the share price. I almost couldn't tell you what the share price is of half the thing. It's just not at all relevant to me. That the number that you're buying it at, like it's how many pieces of when you cut your pie up or your pizza or your cake. Like, if you're feeling hungry, do you cut it into 8 pieces or do you cut it into 4 pieces? Like it's totally irrelevant. You do the valuation.
I use this actually as and maybe I shouldn't even say this publicly, but I use this as a tell when I'm talking to someone to see kind of what kind of investor they are. If they talk in share prices, that's completely different to me if they talk in market caps.
Market cap, yeah. Or even enterprise value.
Now that's the Winnie the Pooh in the tuxedo down is for enterprise value.
Yeah, that's right.
I tell you the one thing that I do, like the restoration hardware research project that I did, I will look at potential dilution. That I think is really important, because if you just look at market cap and you don't know what kind of dilution might be on the come, you might quote a market cap and be completely wrong on what the actual true market cap that you could be buying is versus what you
fully
think you're
diluted.
Buying. Yeah, that's right.
Yeah, that's a good nuance.
That's the only nuance. That's it.
Yeah,
there are no others.
I couldn't agree more.
Well, this has been fun. I'm in quite a mood.
Yeah,
I'm amped up today.
I think
when I got my mic working.
Yeah.
Did you get your Peloton delivered yet?
Yeah, man. I did. I told you I've been booze free for what? What are we on? Like day 12? I've been Pelotoning. Shit is looking up for Brewster.
Man, you're ready for Corona. I love it.
I'm trying. I'm not trying to get taken out by this thing.
Yeah, or even more than that. Like I don't want to be a vector for other people who are at more risk.
I canceled my flight to see my grandma. I just told her, I said, I can't. I mean, she means too much to me. She's 91. I'm not taking that risk. So we'll see.
Yeah,
Knock
you could
on
be
wood.
carrying it.
All right.
You could be carrying it to her.
Yeah, my mom too. I was like, just, be careful. So to anyone out there, be safe.
Stay safe out there.
Yeah, thanks, folks. We'll see you next week.
Monetize us, Google.
Move with the rhythm. Shake it up, stop when the clock hits 13. Sing one.